All right, let's talk about a challenge that honestly is a pretty good problem for any investor to have. Your portfolio is doing well, but now you have to figure out how to keep it on track without writing a massive check to the tax man. So today we're going to dive into the smartest ways to get your portfolio rebalanced. It's the ultimate suffering from success situation, right? Your investments did exactly what you wanted them to. Maybe one particular stock just went to the moon, and now your whole portfolio is kind of lopsided. The obvious move is to sell some of that winner and rebalance. But, and this is a big but, the very act of doing the right thing can trigger a tax bill that will absolutely make your eyes water. So let's just make sure we're on the same page here. What is rebalancing, really? Well, think of your portfolio like a garden. You've got different plants, right? Some are just going to grow way faster than others and start stealing all the sun. Rebalancing is it's gardening. You're trimming back those overgrown plants so the smaller ones can get some light. It's all about keeping the whole garden healthy and sticking to your original blueprint. Okay, so here's how we're going to break this all down. First, we'll dig into the core problem, the rebalancing dilemma. Then we'll get to the best possible solution, how to rebalance without selling a thing. After that, we'll cover some smart selling strategies for when you absolutely have to, how to steer clear of a huge tax trap, and we'll finish it off with a real pro-level technique. So here it is, the heart of the problem. When you sell an asset that's gone up in value, which is what you have to do to rebalance, you realize that gain. And the second you do that, boom, you've created what's called a taxable event. That profit is now a capital gain, and you better believe the government wants a piece of it. Now, if you look at the rates for long-term gains, that's for assets you've held for more than a year, they're actually not too bad. I mean, we're talking 0, 15, or 20%, which is usually way lower than your normal income tax rate. But here's the kicker. It's still a tax. It's still money out of your pocket. And oh boy, this is where it can get really painful. If you rebalance by selling something you've held for less than a year, that's a short-term gain, and those gains get taxed at your regular income tax rate. We're talking rates that could be 24%, 32%, even 37%. That turns a smart portfolio move into a really, really costly mistake. So the big question is, how do we get around this tax trap completely? Well, let's talk about the most powerful, the most elegant solution of them all, rebalancing your portfolio without selling a single thing. No selling means zero capital gains. And you know what? It's actually a pretty straightforward 4-part playbook. First, any new money you're investing, don't just sprinkle it everywhere. Shovel it all towards the parts of your portfolio that are lagging behind to bulk them up. Second, take control of your dividends. Instead of just letting them automatically reinvest, redirect that cash to the assets that need a boost. Third, same goes for any other cash flow, like interest payments. And finally, and this one's a game changer, use your retirement accounts. Your 401k, your IRA, think of these as your rebalancing playground. You can buy and sell inside them all day long with zero immediate tax hit. It's the perfect place to make these adjustments. Okay, but let's be realistic. Sometimes, especially if you have a big gain in one area, selling is pretty much unavoidable. But the good news is, if you have to sell, there are some really intelligent ways to do it that can dramatically shrink or maybe even completely wipe out that tax bill. The number one strategy here is called tax loss harvesting. It sounds complicated, but it's not. All you're doing is strategically selling some investments that are down in value. This creates a capital loss, which is like a tax credit you can use to cancel out the capital gains from the winners you have to sell. You're turning your losers into a tax-saving superpower. And look at this. It's such a perfect illustration of how powerful this is. On the left, you've got a $3,000 gain you need to take. You're going to pay tax on all of it. But on the right, you find a loser in your portfolio and harvest a $3,000 loss. What happens? They cancel each other out perfectly. Your net taxable gain is zero, zilch. You've rebalanced and you owe nothing. It's fantastic. Now, here's a technique that a lot of investors totally miss. It's called HIFO, which stands for highest in, first out. See, if you've bought the same stock or crypto at different prices over time, the IRS actually lets you pick which specific shares you sell. So with HIFO, you cherry pick the shares you paid the most for, which of course minimizes your gain. This crypto example makes it so clear. Let's say you bought Bitcoin at 20 grand, and then again at 50 grand. Now you're selling at 40. The default method, FIFO, sells the first one you bought, sticking you with a $20,000 taxable gain. But if you use HIFO, you tell your broker to sell the one you bought for 50 grand. The result? You're actually booking a $10,000 loss that you can use to offset other gains. It's the same exact sale, but the tax outcome is night and day. Okay, I have to give you a word of warning here. As you start getting into tax loss harvesting, there is one critical, non-negotiable IRS rule you have to know about. It's called the wash sale rule, and it is by far the most common trap people fall into. The whole point of the wash sale rule is to stop people from cheating the system. It basically says, look, you can't claim a tax loss on something if you turn right around and buy it back. The IRS says if you buy the same thing or something substantially identical within 30 days before or after you sell, then you didn't really get rid of it, so no tax loss for you. This timeline really helps visualize the danger zone. It's not just 30 days after you sell, it's 30 days before too. It's a full 61-day window surrounding your sale date. If you want to legally claim that tax loss, you have to stay away from that investment for this entire period. So what in the world does substantially identical even mean? Well, the IRS is a little cagey about it on purpose, but here's what we know for sure. Stocks from two different companies, even in the same industry, are not identical. And this opens up a very common and totally legitimate strategy. You can sell, say, shares of one specific company for a loss, then immediately put that money into a broad sector ETF that just happens to hold that same stock. This way, you get to claim your loss while still staying invested in that part of the market. All right, to wrap things up, for those of you who really want to optimize things, let's touch on a more sophisticated strategy that big institutional funds often use. What you're looking at here is a strategy called dynamic rebalancing. Instead of actually selling the stocks themselves, this method uses low-cost financial tools like futures contracts to constantly make tiny adjustments to the portfolio's balance. By doing this, it's able to capture little bits of value from the market's everyday ups and downs. And as you can see from the chart, over a few years, all those tiny little wins can actually add up to some serious extra returns. And that really brings us to the final and most important question you need to ask yourself. After seeing all these different strategies, take a hard look at your own approach. Is your rebalancing process actually working for you and building your wealth? Or is it accidentally just working for the tax man?